Who controls the money often controls the outcome. When a country faces economic disaster, its currency collapsing, inflation spiraling, foreign reserves vanishing, there is one institution governments turn to: the International Monetary Fund. But here's the question few ever ask: who really owns the IMF? Is it a secretive global elite, a single superpower, or simply a cooperative of nations? Welcome to Finigma, where we decode the systems behind global money and power. The IMF was created in 1944 at the Bretton Woods Conference, during the final stages of World War II. The global economy was shattered, trade broken, currencies unstable, and nations struggling to recover from the Great Depression. Its purpose was clear: stabilize exchange rates, provide emergency funding, and foster international monetary cooperation. Today, it has 191 member countries, each contributing financially. But ownership here isn't like a company, it's a system of quotas. A quota determines three things: how much money a country contributes, how much it can borrow, and how much voting power it holds. Voting is weighted. Bigger economies get more influence, smaller ones less. The United States, with the largest quota, controls over 16.5% of the vote. Why does this matter? Because major IMF decisions require an 85% supermajority. In practice, this gives the U.S. veto-like power. Other large shareholders include Japan, Germany, France, and the United Kingdom. Together, these countries hold the majority of voting influence, guiding global economic policies and decisions. All member countries technically own the IMF, but power is concentrated. The IMF is governed by a board of governors, one per country, and an executive board handling day-to-day operations. Larger economies often appoint their own executive directors. Smaller nations are grouped together. The managing director traditionally comes from Europe, while the president of the World Bank has historically been American. This reflects the historical global hierarchy of 1944, a structure still influential today. When countries face economic crises, foreign reserves running dry, or debt payments failing, they turn to the IMF. Loans come with conditions called conditionality, which can require spending cuts, tax reforms, privatization, or monetary tightening. Major contributors influence how these programs are structured, determining risk frameworks and shaping policy recommendations. Ownership and power intersect here. Those with the largest quotas wield the most practical influence over how the IMF operates globally. The IMF also monitors fiscal and financial systems worldwide, producing reports and forecasts that impact investor confidence, currency valuations, and interest rates. Emerging economies like China, India, and Brazil argue that voting rights should reflect modern economic realities, but power remains concentrated among the largest contributors. Gold, currency stability, and foreign reserves are central to its operations, historically tied to the gold standard and now focused on stabilizing fiat currencies and financial systems. In short, the IMF is owned by all member nations, but influence is weighted, and voting power follows money. The institution doesn't secretly control countries, but its decisions shape the global economy, affecting capital flows, interest rates, and investor confidence. Conditionality, surveillance, and strategic influence mean the IMF's power extends far beyond simple ownership. So when someone asks who owns the IMF, remember, it's a cooperative of nations, but the largest shareholders guide global finance. Ownership explains structure, voting reveals influence, and influence shapes outcomes. The IMF is not a shadowy world government, it is the reflection of economic power in action,